I tell people straight up what I make on every single loan, right?
What's their
And then
reaction? Do they ever say like, dude, that's bullshit, like you're making too much money off me, you need to make 500 less? Like, you ever get any pushback? Thank you for checking out Real Talk Personal Finance. Shit's about to get real. Cash Flow King with you today, and today we have a very special guest. This is actually our second guest from Podmatch. I think those of you that have been listening to the show have heard me talk relatively recently about we joined a new platform called Podmatch in an effort to try to get more guests on our show in 2026 with different perspectives. So in a moment, I'm going to welcome Philip Ganz to the show. Just a quick little bit about him. I'm going to read a little excerpt here from his bio on Podmatch. Phil spent over 25 years in the mortgage industry, closing over $1 billion in loans, working with everyday home buyers as well as serious real estate investors. And we're going to talk about all things mortgages today, maybe get into some strategies, things like that. So please welcome to the show, Phil Ganz. Phil?
Hey, I'm very thankful to be here today and to share some knowledge with your audience and help out everyone on this journey.
Awesome. So I noticed that you, I was looking at your website a little bit. We talked a few minutes before we started recording here, and it looks like you have and are working with both first-time home buyers and also real estate investors. Is that right?
Absolutely.
Okay. So tell us a little bit about your background, how you got started, how you got into mortgages, and kind of, what that looks like.
Yeah, I started May 7th, 2001. I became a telemarketer for a company called AmeriQuest Mortgage. It's not there anymore. But to be upfront, I never wanted to get into mortgages. I only got in because it was the only job I could get because I graduated December of 2000 and obviously in 9/11 and then I wasn't able to do the Peace Corps. So that was my first job into everything, So
Gotcha.
I started from the bottom up as a telemarketer.
Okay. And so I'm just out of curiosity, when I started in financial services, that's my background. I remember there were days where we were cold calling back in the day, and like we would make over 250 calls a day. Like, were you making a bunch of calls just nonstop?
Yeah, I was making over 300 every single day.
Wow.
Um,
That's a
I
lot.
was nonstop, and this wasn't like no auto dialer. This was just me being a maniac and laser focused. I wouldn't have any distractions. And just, that's all I was at that point was a telemarketer. And I was, fighting for my career at that point. I didn't want to get fired. So I tried my best to, be successful.
So what did that look like? You started off, you're punching the numbers in by hand, you're making over 300 calls a day. How does that career journey progress over time? How did you transition from telemarketer to the next step?
Yeah, so when I started off as a telemarketer, the guy didn't want to hire me and he was forced into it. And so he didn't want to like progress me to like loan officer. So the manager didn't because he didn't like me. But I was like the best telemarketer they've ever seen. And then the loan officers didn't want to become a loan officer because they would lose their layup loans because I was very good at setting appointments. So, once the manager got fired and there was a new manager, I was lucky at that point to, ask if I could get the opportunity to go to the next step. But like, they didn't want to trade me. So I had to kind of just figure it out on my own and, try to help out as many people to become a loan officer for AmeriQuest Mortgage.
Got it.
And then from there, I became a branch manager. I became a very successful loan officer very quickly, and for another year and a half, and then I wanted to. I got the opportunity to run a branch. I turned that branch around, and that was very successful. And but I didn't want to do AmeriQuest Mortgage anymore. So then I became a branch manager for a company called Partners Mortgage. That was for about a year. That was a mortgage broker, but mortgage broker was way different back in the day. And then from there, that company got bought by a local regional player called Mortgage Network. And that was right around 2007. That company collapsed. It didn't collapse, but it almost collapsed. They ended up surviving, but 2007 kind of, what I would call it either wiped you out or it changed things. So I joined a company at that time, was one of the first hires in the Northeast called Guaranteed Rate. It's called rate.com right now. And then I worked there for about 4 years, was very successful there. And, I left there and joined a company called Fairway. They're a great company. I was there for about 8 years. They're fantastic. Joined a company called Movement Mortgage for about a year. They're also very good. And then I decided it's time to start my own company, Next Wave Mortgage.
Yeah, that's what I was going to say. So that's where you're at now, Next Wave Mortgage. You're the president there and the
Yes.
founder, correct? Okay.
Yes, but I took every job very seriously. As the industry evolved, I'd always take everything very seriously and try to get better every single day.
So you were working with? Did you start working with first time home buyers? Did you start with investors? How did you cross over into the investment side? I know on the message I think that you had sent us on Podmatch, you mentioned DSCR loans, which we've talked about a little bit on the show before, especially when it was brand new to me several years ago, debt service coverage ratio loans. How did you start working with investors and like what was that client transition like? Or I think you said maybe you still work with both today. So how is your, approximately like percentage of your business that's investors versus primary, homeowners?
Great question. When I started, we'll add a lot of first-time home buyers, right? But first-time home buyers, their first investment is their primary residence. But that eventually becomes sometimes an accidental landlord. So being in the industry for 25 years, you build up a big database. But the big transition is really when I became a mortgage broker over the last 3 years. And the reason why is because I have way more different investors, right? As a mortgage broker, unlike Expedia, right? So I have over 100 different investors, and the price is a lot less than what you would see with like retail. So there's kind of like two different models that are out there in real estate and mortgages and restaurants and food is retail versus wholesale. And I'm wholesale. So, you get more products at a lower price. And when you're an investor, price matters the most. It really does because the math has to math. You know, there's not really as much emotion as a first time home buyer, right? And so that really was like a big shift because investors want the best deal. They want the lowest rate. They want the most flexibility. So that really transformed it because, they knew where to go. And that was Phil Ganz at Next Wave Mortgage. So I love first time home buyers. That's where my heart is. But, investors find you when you have the lowest price. And investors check you versus other people. But investors know other investors, right? So I've gotten referred a lot.
Yeah, and the other thing too that's talked about oftentimes is that you have a primary or a homeowner that's buying a primary residence, right? And they're going to be getting a loan for themselves for their primary residence. Eventually, like you mentioned, they could turn into an accidental landlord. But if they stay for a certain period of time, you're probably going to close a loan with them once every however many years. Versus an investor, generally speaking, they're probably a little bit more active, so you can close multiple loans with them over time. So like the lifetime value of your investor client or investor customer, even though they want the best deal, if you can repeatedly do deals that make sense on both sides of the table, then that's even better for you, right?
Absolutely. And we've helped out a lot of people doing this. It's been a really big advantage. To be totally transparent, I didn't know how big of an advantage it would be. You say why? Okay, let me walk you through like the why. Because like when you're on retail side, right, rates aren't as good. It's like just being like truthful, right? And so, but people don't always care. Like, even though my rates were good, right? Like they don't care as much. Like retail consumers, they don't care. But price matters when you're on the like investor side. So once I was like, oh yeah, you can get like a 30-year fixed at 6.25, or less. That was their deals would work, right? And so it creates a lot of like loyalty. It's the way I kind of describe it is like imagine Costco, right? I remember one time I was in Costco and I was like so amazed when I first went in. I said, this is when I was much younger. I'm 48, right when it came out. I said to them, "Oh, your floors aren't painted," and I don't know why I said that, but the manager said, "We don't have to," and that always like kind of like stuck with me, right? Like the prices are so low, right? Like even Costco didn't think it was gonna like work, right? I mean, they started off Costco, I think, bought Price Shoppers, and those started off on the West Coast, and then it was always about the lowest price, but people always doubted the model, right? And then in the end, the model mattered more than anything else, right? That's why it's called Costco wholesale,
Yeah,
right?
we,
And there's
we
no
love
difference.
Costco on this show. We talk a lot about Costco here. So that's good.
I mean, it really matters, right? Like, and I know people shop on me all the time, right? I show my computer screen. This is how funny it is. I literally like if you're visualizing this, like, and you're listening, visualize like Expedia right now. This is the right way to visualize. Like, you'll see like all the hotels. Like with me, you'll see like all the investors, and I tell people what I make every single time.
On the
They're
loan? On each loan?
yeah, on the loan, you have to, right? Because you know it's going to show up when you lock your loan, and that's the thing is, people think it's quote a disadvantage as a mortgage broker because you show what you make, right? So I tell people straight up what I make on every single loan, right?
What's
And
their reaction? Do they ever say like, "Dude, that's bullshit. Like you're making too much money off me. You need to make 500 less." Like, do you ever get any pushback?
No, not really, because I'm already at a low level and my price is so much better. I don't care. Like
Gotcha.
my thing is that my price is so good, you're not gonna get that lower of a price, and you get me. So the price is gonna be unbelievable. It's like way less than what you would see online. I actually show this. Like what will happen is I'll start like with the investors, like I'll pull up like Rocket Mortgage online, right? And then I'll show up their wholesale rates. And people like I'll give you like an example, right? They'll look at say like a wholesale rate, it'd be like 5.25. Their retail rate would be like 6.25 or 6.5. I mean, it doesn't matter. People will send me screenshots from online, and and their biggest thing is, and you can tell because they're shopping, right? They'll send like screenshots, like their loan officers, like there's no way this could be accurate. Like no one's arguing at this point, like, is this like, can this like a good deal? So because they're not arguing it's a good deal, everyone already knows it's the best deal. Their competitors are trying to, and then I'm like, read all my good reviews, 100, 200 good reviews, 300 good reviews. Then they're like, yeah, you know, they can't believe, they eventually, like, I don't really lose deals on like the wholesale side. Like when I was in retail, I'd lose deals like what, like way more often than I would lose in wholesale, because like wholesale is like if I have the customer, you're not going to someone else, because who would want to just say, oh, I want to take a higher rate. Now, conversely, now sometimes I don't get the deal because like the customer either will have to close quick, like they're closing in like 3 days. So sometimes time will allow me to win the deal, or like it's their brother doing the loan and it doesn't matter. They have to go with the person. But if it's like an equal playing field, I'm gonna win. Like most of the time. Like I'll definitely win. And it's because the price is not even, it's not even like close. It's wildly. In fact, that's the reason why, if you look at the market share, wholesale is growing much faster than retail. And you're like, no way. In fact, the world's biggest mortgage company, UWM, is what? Wholesale. They started wholesale. The second biggest company, Rocket Mortgage, wholesale. They have retail, but don't be confused. Their wholesale channel is growing very fast, right? And now the companies start to want to, start to get into it, right? But wholesale is going to continue to grow rapidly, right? But banks love retail. You say, why? The profit margins are high. You're like, what do you mean? That means in English, your rates stink. Of course, they want to give you a crappy rate, right?
Yeah.
It's so the only difference where retail might win, the only difference is if you're like super wealthy and you're basically getting a loan on your investments, like a big jumbo loan, like you're borrowing $3 million and you have but even then, like on bigger loan amounts, like retail sometimes really struggles. It's not always easy, but I'm happy. That's why the numbers just play out the way they do because it's just, the maths in the wholesale channel.
Yeah, let's talk about DSCR loans for a little bit here. So I know, and I can talk a little bit about my personal experience, and I'm interested to see what you think about this. So we do a lot of different types of investing personally. We got a small portfolio of 8 different rentals. 5 of those are in a DSCR loan under an LLC. 3 of them are in a trust. It's a separate portfolio. And I remember this is way back, and I will fully admit, like I got lucky. I didn't really know, what I was doing, but I remember basically doing a DSCR loan. I was able to take cash out. We had a magical run up over that period of time. I pretty much got all my money out, and then I locked a 30-year fixed at 3.75%. And I did negotiate that down a little bit, and I talked to multiple people over that time. But before the DSCR loan, when I would just get individual conventional mortgages as an investor, I would usually have a relationship with one loan officer, and I never really questioned their fees or their rates or try to beat them up or shop them out. And maybe that was a mistake on my part as an investor. I don't know. But like for the DSCR loans, talk to us about, I guess first, explain if you want to what that is, why an investor might want to use it, and then anything else you want to add about it. Because I know there's a lot of people out there doing a lot of marketing, and that was one loan type that I did shop out pretty aggressively. And looking back, I look like a genius, but in reality, I just got lucky. It was just dumb luck. But nobody around me at the time really knew much about these types of loans, and I was happy to be able to get it the way that I did. But I never thought that I could do that and get such a low rate that was more competitive than the conventional rates were at the time. I know I did a weighted average of the different loans I had out on those 5 properties, and it was like it was a weird number, 5.01. I won't forget it, just north of 5%. And I got it down to 3.75 with cash out. And I'm thinking, this is crazy. Now, the only thing, and maybe we'll get into this a little bit, that I didn't really like is I essentially cross-collateralized the portfolio. So if I ever want to sell one of those individual properties, and let's say I sell it at a gain, those proceeds have to go towards paying down the loan. That money doesn't come to me. So let me pause there. Talk to us about DSCR loans. What are your thoughts on any of that?
So let's talk about what a DSCR is for the audience. So what it stands for is debt service ratio. And what banks want is they want the rent to be greater than your total housing expense, that's your mortgage, your taxes, insurance. If it is equal, it's considered a 1.0 ratio, okay? As the rent exceeds the mortgage, it increases above 1. So if the rent was twice as much as the total housing expense, you'd be at a 2.0, okay? This is really important. The higher the ratio, the better pricing you'll get. I totally love this. It's based on the property, not necessarily the consumer, right? So this allows the investor to totally scale up, like you were mentioning. You can take out more cash. It's very easy to go quick and get really good pricing. The other thing I would also say is, like you mentioned, it's very easy to put it in an LLC in the beginning, okay? That's really important. One tidbit there is when you put the LLC address, the name of the LLC will be the property, but you should always put the address as who manages the property, actually where you currently live also looks like a primary residence. Sometimes first time investors make this mistake, and I got to get like corrected, right? And like I said, you can put it in an LLC, you can put it in a trust. You can control the prepayment penalties. Sometimes prepayment penalties are genius because you can get a super lower rate. It's about the property's income. There's different investors that will do Airbnb income, short-term rental income, vacant properties. It all goes into the pricing. And you did mention something like really good. You mentioned the retail experience, right? Like if you're dealing with like a bunch of different banks, then you have to kind of like, it takes a lot of like effort, right? But if you dealt with like one mortgage broker, he already has all those banks like Expedia, and you already know what he makes, so it's very like straightforward and easy. So I would have told you just get your trusted mortgage advisor that's in the wholesale channel, and you can save even potentially more money, right? But I definitely love these debt service ratio loans because you do get lower rates than conventional financing. That's where the market is right now.
What are you
It's
seeing right now? And I know this is probably a loaded question. Let's assume credit's excellent, all those sorts of
You're
things.
in this low sixes, depending of your situation, 1 to 4 units. You're in the low sixes, low to mid sixes, and it also that's what I'd say. You're in the low to mid sixes on these type of loans, as long as you're over one. If you go to 1.2, you're better. 1.4, you're better than that. Two, you're better than that. So how strong your rents are, and then obviously how strong your LTV is. If you're 25% equity, you're better deal than 80%, or the more equity that you have. So, it's a risk-based loan. The lower your risk, the better the pricing. So if you have a higher DSCR number, like a 2.0, you're going to get a better rate than if you're a 1.0. So that's also good. Also, your loan to value. If you have 30% equity, you'll get a better deal than if you have 20% equity. Okay? So you can really drive down these interest rates. And you also have the advantage of adding a prepayment penalty. A prepayment penalty is not a negative thing. It's a feature to the loan. So on a conventional loan, you cannot even get a prepayment penalty. That gives you worse pricing. A lot of investors don't realize this, right? So that's also an advantage. If you know you're going to keep the loan for 5 years, you get
Right.
a 5-year prepayment penalty and drive down the rate.
That's
The other
exactly what I did. I had a 5-year step down. So,
Yeah.
yeah.
And then the other thing I would say is, let me tell you about non-cyclical advice. A lot of retail people will tell you, oh, put it in this conventional loan, and then the next day or later on, put it in an LLC. Well, let's talk about those issues. One, you don't get the protection from the LLC anymore because it went from personal to business, right? So it's very easy to break the LLC, and then you can be personal liability. So it's very good that you start off the transaction day one, or call it day zero, as a business. If you started off that, you're more protected, right? And then you can get the insurance in the LLC's name, and everything started off perfectly. The other thing is that also when you do your taxes, by starting it off in the right way, you're now an aggressive investor. You're not passive income. So if you get audited, it's much easier to show that this is for all the tax advantages, is what I would tell you.
Yeah, so would you say, I know you said low to mid sixes, so I did this with a five single family property portfolio, and I'm happy with it, obviously, and, looking back and where things are now.
What year did you do this in?
I want to say it was 21. I'd have to go back and
That
look.
was the best time
Yeah.
ever, right?
Yeah, right. But
So if you want comparison, right? Let's comp this out, right? Because we know, right? We know for a fact that DSCR loans are lower or equal to than a conventional primary residence rate in the best case scenarios. They just is. Right? That's a good way to track this here. What's the best out there is very close. So if the best people were really getting at the time 2.5 or 2.25, you could have get into twos. But I want to tell you this. is that you did exceptionally well. The competition for these investors is much tougher now, and there's more investors pouring into this market than when there was in 21. So in 26, the marketplace is every investor. Everyone's doing these loans, right? So there's more competition. So you did very well for the year 2021. But if 2021 had the level of if that loan had matured because now everyone's involved, your rate would have been much lower than 3.75 because the comp would have been what people were getting on the primary residence loan.
So I guess where I was going to ask is like, is there a certain number of properties that ideal? Let's say somebody's doing single family rentals where they would want to consider a DSCR loan. Would they do it for a single property? Would they cross collateralize a small portfolio? What are you seeing out there?
Yeah, there's no reason to cross collateralize because in the marketplace today, there's so many different investors that want that business. Now, no investor will do 10 million at once, but I could easily get two investors to do five or three at 3.3. So luckily, while that feature is available, there's no need for it. You're never trapped anymore.
So was that something more common back then that's less common now because of the increased investor competition? Is that what you're saying?
Correct. That's exactly right. In 2021, like I would tell you, it was a new product. Now the product is fully mature. Now every bank, I have over 100 banks. Every single bank, there's not one of them that doesn't do a DSCR. So you'd say 100 for 100, right? In the year 2021, I would tell you is probably like 5% of the banks that offer that competitively, right? That really want the business. So you had just early adoption or just the product getting out there versus massive adoption, right? Okay. And that's just something that's changed. And you're right. People back in the day had to take these loans that had like crazy features. Like I had to take out a loan at another bank that was like a DSCR loan. And during the process, they made me put down more money. I had a 5-year ARM. They gave me a 5-year prepayment penalty. And then I had to refinance it. And then they added the prepayment penalty. They added more years in the prepayment penalty. I mean, I'm still in the prepayment penalty, but they really, because of these features, got me in a much tougher situation, and I was forced to actually just refinance to a 15-year loan, which is nuts. I guess I'm paying it off, but I got like 4 more years of prepayment penalties. I think they gave me like an 8-year prepayment penalty.
Wow.
Like the whole thing has gotten so much better because of competition. I would have never gotten myself in this. Same with you. Like it's the same thing that happened. You got this crazy cross collateralization. And Phil Ganz got an 8-year prepayment penalty. Right?
And I guess I can appreciate that it's different now, but I'm actually kind of sort of okay with it. The way I looked at it was, hey, I am in this for the long term, buy and hold, and I don't plan on selling any of these particular properties. And if I do, then that's just something I have to contend with. But I kind of view it as one portfolio, even though they're technically 5 separate addresses and 5 separate single families, and I'm okay with that. But where I'm kind of toying with the other ones now, one of them, we got a conventional loan in the 3s on the trust portfolio, and I'm fine with that. But the other 2 are in the 6s, and it's like, well, does it make sense? I talked to somebody not too long ago on a DSCR loan, and she couldn't beat the rates, but they were in the mid 6s, and it's like, does it even make sense to do this? Like, what are we talking about here? And it was pretty much, I didn't see an economic reason that it would make sense for me to go ahead and do a DSCR for those 2 houses. Do you ever see people do it for just one home, or are they typically doing multiple, or is there an advantage or disadvantage to doing it one way or the other?
Yeah, you brought up a really good point. When is there a need, right? So I typically find out there'll be a need when people want to buy more properties and they do a cash out. Unless you're really dropping your rate, it's not worth the cost of refinancing on a rate and term. Unless the rate's really going down and you can recover all your costs in less than 60 months, I wouldn't refinance unless there's a need. When people want to buy more homes, that's a good way to do it. I tell people sometimes the best money is the money you can't touch. So don't refinance, just rate and term, refinance when you need to do something.
Yeah. Okay. What if somebody? Do you ever do DSCR loans for one house?
Yeah, of course.
And are people more likely to do that? Let's say an investor has a need and they're like, all right, well, you know, there's something that I want to do, and they have multiple houses. Would they do a separate DSCR for each one? Would they group them together and somehow not have cross collateralization? Is that even possible?
Yeah, I never do cross collateralization, right? I stay out of that. Like we have that, but I don't even I don't want to tie up my investors' portfolios, right? Like I just do one at a time. I take the highest rate or the most equity, and we go from there to see if it makes sense.
So you can have somebody with multiple properties and they do multiple different DSCR loans, and that way they're not having to cross collateralize. Is that what you're saying?
Yeah, yeah,
Okay.
because there's a premium to having flexibility. You know, you don't want
Right.
to tie up people's cash, right? It's wild, right? Like people need to be able to use the money whenever they want to use it.
So what are some strategies that investors are using these days that you're seeing out there for different types of loan products?
Yeah, I mean, I would say the biggest thing is that investors now can really, take out cash at a good price. This is a big thing. Cash out refinances and DSCR. That cash out really doesn't hurt your premium in terms of your rate. You know, people are willing to give you the cash almost like at the same price as rate and term now. So they're looking for deals to be had, right? So there's a lot of flexibility and you can close pretty quick, right? This is, something very, imperative, but they're definitely out there. Depending on what area that you're in, right? Like, every part of the United States is different. Like, half my business is in Massachusetts and half is in Florida. So these are completely different markets of what people are looking to. And Florida has a lot of territory. I mean, I'm licensed in 11 different states, but you never know of all these, the way the economy can be up and down. But I'll tell you, I love investing in real estate. There's nothing better.
Yeah. So is that from a personal investment philosophy standpoint? Are you kind of a buy and hold rental guy? Is that your main thing?
Yeah,
or?
I do. I like it. I got to tell you, I like buy and hold. I like 12-month leases. I get to put up my hand every time. The only time I lost was when I went into it thinking this would be short term. I wanted to hear nothing about short term again. I did a flip once, lost money, forget it. Terrible.
Yeah, I have some people trying to get me to. We have a couple of friends that are home builders, and one of them builds for investors, and it's like, yeah, he pretty much charges a builder's fee and you put your money in, and then we have a friend that's essentially the listing agent, and pretty much everybody else is guaranteed to make money, right? The builder gets the builder's fee, the agent is going to get the commission when the home sells, but you're taking all the risk as the investor, and if there needs to be a price reduction or something like that, your money is the first to go. Not to mention, who the hell wants to create a bunch of short-term gains at the same time, even if you do get lucky and the thing sells? Like, it just seems like a major headache, and a couple of people in our personal circle are like, you're crazy not to do this. And I'm like, it's not interesting to me. I'd rather do, the single family thing, or we do a lot of real estate syndications. We don't raise money, but I invest passively as a limited partner in different syndication deals. And, again, it's all about long-term. I have no interest in essentially doing a flip or having somebody else do a flip where I am the one taking on massive amounts of risk.
Yeah, I totally agree, right? Like, even if you buy something like long term and you don't even buy it at the right price, right? So you just wanted to buy it, right? And over time, it's still going to be a great deal, right? It catches up very quickly.
Yeah, time is very forgiving in real estate. I agree.
Right. It doesn't matter. Like, it's still going to look like a winner, right? Like in any major city, not everyone, but most of them, if you bought like with every 10-year period, you crush it. So it doesn't matter if timing doesn't matter in any of this. It just, and then the other one I lost with, horrible, I'll tell you the story. I bought in North Fort Lauderdale. I had this idea of an Airbnb. It was right after COVID. I'm like, I'm going to kill it. I'm going to make all this extra money. I got crushed. I lost so much money. Oh my God. It's just like, because you pay a management, it's the same thing like everyone else makes money. You pay a management company. They charge you 20% just to run cleaners through a century. Complete scam. They overcharge you the cleaners, they kill your overnight fee. It's just like by the time you get nickel and dime with all of the supplies and this, you're like a minority partner. Like it's just such an awful deal. You're much better off just doing 12-month rentals and knowing what you're getting versus dealing with like third parties, right? So
Yeah.
total, because people promote the shiny thing. It's like you'll see this. It's like, oh, World Cup, great. One family made money because for like 2 months, right? And they glamour some like quick win, but the reality is that one that was lucky, and then it's like promoting the lottery is a good business strategy is one. You know what I mean? Can we just talk about this? It's so ridiculous that people do this, and we love to promote like lottery methods, right? I don't like the lottery.
I hate it. I hate it. I mean, there were guys, we used to have a poker game, and there were guys who were like, hey, we're all going to throw in, whatever, $1, a couple dollars, and the jackpot hits such and such. What do you mean you don't want to be a part of that? I'm like, I just don't care. Like, it's a tax on poor people. Like, everybody in this room no one here is poor. We don't need to do that. And I understand there's a fun element to it, and I'm not saying I've never, played a scratch ticket or anything, but like, there's people that consistently play, and they actually think somehow long-term they're going to come out ahead, and they're just wildly mistaken.
And I love, to be honest, I love doing what I do, right? If I won the lottery tomorrow, I wouldn't change anything. In fact, there was a big jackpot, I think a couple of months ago. My wife was planning her new life if we had won. And she asked me, well, what are your plans if we win? I said, nothing. I'm going to continue on. And she was like bewildered with my responses. But I love to do what I do. I wouldn't be doing it for 24 years. I want to compete. I want to build. I want to grow. It's not about the money. I love helping people. I really love helping people. But I think it's such a loser mentality that I hit the lottery and I retire and do what?
Yeah, exactly.
Like, what are you going to do? What's your end goal? What,
They're going to blow it all. They're going to blow it all. And then they can't qualify for a mortgage with Phil.
You know what I mean? And then what you see is Elon Musk. Elon Musk could have retired at PayPal. Let's talk about that. He could have retired at PayPal. He had like $268 million. What does he do? Yeah, starts Tesla. Then what does he do? Starts SpaceX, right? And then, his first 2 rockets didn't go through. And if the third one didn't go through, then he wouldn't have gotten the money from NASA. And then Boeing would have gotten the contract and he goes bankrupt, right? Like he's all in. And then the guy's the first trillionaire, and everyone says all these losers are like they hate this guy. And he's like the biggest winner. Like if you don't celebrate winners, then you'll never have any success of your own, right? Like it's like hating on Michael Jordan. Like I'm so happy that someone was so successful and that achieved so much, right? Do I admire everything about him? No, there's a lot I actually don't admire about him, right? Like, Father's Day may be awkward for him, but that's another topic, I would say. But it doesn't matter. As a business guy, as a winner, I mean, he is the apex, and I, congratulate him. But he doesn't want to ever take the foot off the gas. Same with Warren Buffett, right? He's still, he had to do like a fake retirement. Same with Steve Jobs. Same with all these people, right? Like, why is this retirement at 62 celebrated? And by the way, when retirement first came out, the average guy who died at 55 and retirement is 62. The average person lives to 85 and 62. And now, you're going to be like homeless if you stop working at 62. And I just think this is just like a bad way to look about it, that just stop. Like as a guy, as a man, your job is to win. That's what we do. You got to compete and win. It's not that I think you lose yourself when you stop working. You lose your identity. You lose who you are. You become, you're not as sharp. You can't learn things. You struggle. All of a sudden, a new feature comes out, like on the iPhone, and you don't even know how to hit the update button because your brain becomes a marshmallow.
Do you think that's true for everybody, though, or do you think that's true for people that retire and they don't have something to retire to?
No, that's true for everyone.
Really?
Like people that want to stop, you know, the mentality, if you have that loser mentality of wanting to stop, then you got to find an old passion, or else you're just going to be miserable. You'll be a miserable old person.
Right, that's what I'm saying. If that person has a passion, though, like let's say they retired from traditional work or employment or whatever, and then they decided, you know what, this is something I'm passionate about. I'm going to pursue this hobby or this interest, and that becomes the fuel that drives them. Does that change anything?
No, because they're going to be more successful. In fact, you see this, the most successful entrepreneurs are old people. This is historical, right? You're more likely to see it succeed at 50 than you are at 21 years old, you know? Mm-hmm. And that's like something so important that people need to realize, that you absolutely do not want to slow down or do anything like that. You just want to be able to put the pedal to the metal and keep going as fast as you can, you know?
Okay.
If you want, there's something called the blue zones where people live the longest, right? And if you want to live the longest in these blue zones, then you have to really, they keep working. They don't stop, right? So if the goal is to try to live as long as you can, then you have to keep mentally focused. This is part of it, right? The blue zones have shown this, and I think really smart people realize this.
Got it. Okay, well, are there any final thoughts or anything you want to share with the listeners, or anything we didn't cover today that you want to cover?
No, I think I covered absolutely everything, and it's been an honor to be on, to be honest, to share with your listeners. And, if anyone has any questions, they could reach me at 617-529-9317, 617-529-9317. Always happy to help, answer questions, and have everyone, we're all in this together.
Hey, what you mentioned you're licensed in 11 states. If somebody's looking for a loan, what are the 11 states you're licensed in?
The 11 states I'm licensed in is Massachusetts, Rhode Island, New Hampshire, Maine and Connecticut are pending, Florida, I'm licensed, Georgia, I'm licensed, California licensed. So those are all my licenses. But for investor loans, I'm actually licensed in all 50 states. So for investor loans, I'm licensed in all 50 states. Just for primary residence, you need a license. Got it.
All right, well, we appreciate you coming on to Real Talk Personal Finance.
All right, thank you so much.
All right, thanks, Phil. Take care.
Bye.
Bye-bye.
Check the mic and make sure it sound right, boys.